Before I start, does anybody have any questions for me? So we've got the microphones open, and we'll be starting our webinar in a couple, well, actually in about a minute. Does anyone have any questions for me about the, well, about purple chips? You can use the chat box to send me questions, or you can actually open up your microphone and speak into it. Okay, so Peter is asking me, why do you use EPS and not price earnings ratios? We use the EPS and we look at the price earnings ratios, Peter. We're looking at everything. We actually look at a whole bunch of factors. We're not only looking at those two little metrics. There's all kinds of things like we're looking at cash flow, profitability ratios, all kinds of things. So before we actually make a decision to do something, there's a lot of due diligence involved. Now, let's get started. I hope I answered your question, Peter, for now. We're going to start. So I'm John Schwinghammer, the author of Purple Chips, published by Wiley and available almost everywhere. And what I'd like to do is today we're going to talk about recent volatility and the purple chip strategy and how that affects it. And, you know, how do we position ourselves in a situation like this? So the first thing is we're going to read through this disclaimer. Because I'm an employee of Scotia McLeod, I have to publish this. So just want to mention to everyone that you should be consulting professionals for your advice. For when you make investment decisions, you could lose a lot of money, of course, if you're wrong. Now, let's talk about my thoughts. Okay, the recent volatility has, in my opinion, made a big difference in the way investors view the market and the way that I view the market. And in 2009, I recall that when everyone was extremely bearish, and it seems like this was just, hold on a second, I'm just going to mute everyone there. Okay, it seems like everybody was expecting the market to crash again. And remember, this is when the Dow Jones had already dropped about 30%. And in March 2009, we were at the bottom of the market, and nobody knew it was the bottom of the market, but everybody was convinced that we were going down again and that there was, you know, this was just the beginning of a huge move down. In fact, what happened was that it was the bottom of the market. And of course, since then, we've been rising and pretty steadily at that. And so the Dow Jones just hit 26,500 the other day, and that was just a week and a half ago. And now I think it's the opposite. I think we've seen the high in the market for a while, and it might be years before we actually breach this level again. And so that tells me that that we have to be very careful. Looking here, okay, there's only 12 stocks that we follow today that are at low valuations. And I use this as kind of a gauge of when corrections have run their course. But previously, whenever we had reasonable corrections in the market, we would have like 25, maybe even 50 stocks that would be at low valuations. And so I don't think this correction has run its course yet. And I see this as kind of like the tremor before the earthquake. Not to say that it's going to be, there's no disaster here at all. I think what it is it's going to create opportunity. But we have to be prepared for events like this. And you know, we saw a little bit of what happened the other day. The Dow Jones had dropped, I think in the course of a day, we had 1,500 point range. And then there was another day where it was 1,000 points. That could happen again. So just be prepared. And then I guess the natural question is, so, okay, that's great. We know that things are changing, investor sentiment has changed. So how do we get around this? And how do we keep investing, and how do we make money? Well, that's a good question. Now, let's look at what's driving the change. Okay, first of all, investor sentiment has changed. Okay, rates are rising. This is the first time in the last gosh, since probably, I think it's probably been over 20 years that rates have been falling, and now the writing is on the wall. Rates are going to be rising. Inflation is back. For a long time, people were convinced that inflation was dead, and now we're seeing inflation. Government debt levels are rising. These are all pretty big things, and I think these are game changers. So we have to be prepared for these things. The rules that I think we need to live by in the purple chips world is that number one, cash is king. So we've always got to have some cash to be ready to seize opportunities, because I think we're going to be in an environment where we'll be swimming against the current, and we have to be very, very picky about what we buy. We have to avoid companies that have a lot of debt. If interest rates are rising, you don't want to be in REITs. You don't want to be in utilities, at least not yet, until they get cheap enough. You want to favor companies that are paying great dividends, and you're looking at PE multiples that are attractive. Okay, so you want to favor those companies that have very interesting PEs. So dividends, you want to have no debt, you want to have cash on the sidelines so that you're ready to buy things. The low PEs are good. And by the way, when the Dow was rising to 26,500, we had a situation where a lot of the experts weighed in, and guys like Robert Shiller, the noted economist, very famous economist that has often piped in about his capital asset pricing model, cyclically adjusted PE model, and he was saying that the multiples were such that the market was very, very expensive, historically expensive. In fact, he compared it to 1929. So when you hear stuff like that, you have to recognize that there is some risk in the market. So anyhow, let's move on here. Okay, so I think that in a situation like this, we've got to focus on companies with low or no debt. We've got to focus on companies that have low PE multiples, defensive industries, and industries that are game changers. Okay, so at this point, I invite everyone to ask questions, because I want to make this a bit of an interactive discussion, and I want to hear people's concerns about the market and what people think. You know, we've been accustomed to buying on dips and loading up every time there was a dip in the market. And I'm not sure that was a great strategy, but I'm not sure that that's going to be the best solution going forward. I think we're going to have to be a lot pickier than that, because as I said, I think we'll be swimming against the current. So at this point, I would love to hear some questions. So does anyone have any questions for me about purple chips? And by the way, the next slide, we actually were talking about some of the companies that we thought were interesting, and we ended up buying one of these companies today. You can look at this slide and you see Henry Schein is on that list. Now, Henry Schein came down today, and we actually bought the stock at 65.12. And right now I'm actually looking at the screen, and the stock is at 65.73. So we're making a little bit of money on that. So now I would love to hear some questions. Does anybody have a question for me? I'm sure everybody's been thinking about all this volatility in the market, so and how it's affecting you. So let's hear some questions. So Yvonne,
unmuted.
Hello, John. Okay, that's not a question. Hello, Yvonne. Anyone else have a question for me, please?
So John, so there's still some, so despite the volatility and some uncertainty, there's some big deals potentially coming down the, down the pipe. And I'm specifically thinking about Walgreens and AmerisourceBergen.
Yes.
And what's going on there, and how sort of the healthcare landscape, especially in the U.S., is changing with some massive deals. And most of those, all those involved are on the purple chip list. So, and I noticed that Walgreens was down there for you too.
Yes, and so there have been some massive changes, let's say. There seems to be a shift in the landscape because companies like Amazon are saying that they're getting into everything. And quite frankly, the second that an investor hears that Amazon is getting into a space like healthcare, everybody runs for the hills and the stocks dive, which is what's happened with CVS and Walgreens because, and Celgene actually. I mean, there's a whole bunch that have been affected by the threat of Amazon getting into their space. But as you know, Amazon is not going to lead in every single sector. And so a lot of things have been carried down in this tsunami that we call Amazon. And it is creating some opportunity because I don't believe that all of these companies are just going to get wiped out because Amazon is entering into their space. It's going to change the landscape, but think about it. Amazon is not just going to create stuff. I mean, they went out and bought Whole Foods, okay, because they wanted to get into the grocery space. I think they're going to end up doing the same thing in the healthcare space. And this could be a good thing. And it's going to force consolidation in those sectors that are feeling threatened. So you're going to see pharmaceuticals consolidating. You're going to see the healthcare companies that are, you know, somewhat involved in retail healthcare and let's say prescription benefits management and stuff like that, like Walgreens and CVS. There could be consolidation there too. I mean, this morning, I think it was, well, CVS was talking about AmerisourceBergen, or Walgreens Boots, sorry, was talking about AmerisourceBergen. So ABC went up by 17 or 18%. And Walgreens, I think, is off a little bit. So anyhow, does that answer your question, Blair, so far?
It does, thanks. And Yvon has a follow-up to his hello message.
Okay, yes, I see that. So Yvon is asking, is Fiera Capital still on the radar? And the answer is yes. Fiera is actually a really good company. And the stock, I think, is yielding, I'm just punching it up here. Wait a second. Yeah, right now it's almost yielding 6%. And you know what? I'm going to drag this over here so you guys can see this. Whoops. Whoa, I just lost my Thompson one there. Hold on, there it is. Okay, so there's Fiera Capital. Fiera has a pretty good earnings track record, and the stock is around 12 bucks. I don't know if you can see where my cursor is right now, but the yield is about 5.9%. They pay a 72-cent dividend. This company's in great shape. The valuation is the lowest that we've seen in a long time. It may not go up right away, but I own a lot of stock in this company. I think it's a great dividend. And this is the kind of thing that's going to keep paying us that money. So we want to collect those dividends. In these difficult times, those are the companies that we want to focus on. So Yvon, I hope that answers your question. Yes, Fiera is still a good company. Does anyone else have any other questions for me? Because you can see on my slide here, focus stocks, I'm looking at companies that I think are fairly defensive, like Henry Schein, which is in the dental supply business, Hershey's, you know, in the chocolate business. I mean, the demand for Hershey's is always going to be strong. Demand for dental work is always strong. Fortune Brands owns things like Moen faucets. We're trying to avoid companies that have a lot of debt. You know, companies that are very solid. We're looking for companies that have fantastic track records, which is like CVS and Walgreens and Celgene. And, you know, we're looking at companies that are also game changers like Facebook, you know, Shopify, Square. But you have to be careful. These companies will retrace in a market retracement. So you've got to buy them at the right point. And that's the key. Does anyone else have any questions for me? So use the chat box, or you can open up your mic and go ahead and ask. Or if there's stocks that somebody would like to cover, I'd be happy to take a look at them. If you'd like our view on those things, so we can certainly take a look. I think everyone is shell-shocked from this market. Okay, what do you think of J&J and Disney? Oh, that's a good question. So PK is asking me about J&J and Disney. Now, let's take a look. Okay, we're going to take a look here. Wait a second. Just going to get rid of this little panel here. We're going to look at J&J. Now, J&J is an excellent company. And look at the earnings profile on this. So you've got a nice, beautiful earnings line here. And J&J dropped from about $145 or almost $150 down to $130 recently. And what we're looking at here is a monthly chart. And if you look on a daily basis, it looks a little scarier. So J&J went from 148 down to 129.5 right now. So the big question is, where's it going? And I think in a case like J&J, we were fairly expensive. I mean, the stock was trading around 17, 18 times. Actually, it's trading 18 times more earnings right now, but it had been a little over, I think it was close to 19 times or something, which is historically pretty high for J&J. J&J, by the way, usually will get somewhere in the, let's see if I can grab this here. Well, J&J normally, I think at the low end of the range would be closer to 15 times earnings, 15 or 16 times earnings. So that's why I think this stock it's a good quality stock, but in a market correction, the stocks that are at the high end of their valuation ranges tend to come off. And so I would be patient. I would like to buy J&J, but I think I'd like to buy it closer to the 110 range, or even a bit lower than that, possibly 105. And that may or may not happen. So, I'm trying to be very, very picky about this, but I do like the company a lot. And by the way, let's look at the earnings estimates here. And you can see that in 2018, the earnings estimates are supposed to go up from 728. They should go to 785, and then to 836. So that's the kind of scenario you like. So that's what you're looking for. Now, let's talk about Disney. Disney's at 103 or 103.5, and also, let's look at the daily chart here. And you can see what happened. Disney went from about 113 or so down to 103. Actually, it was at $100 just the other day. And I like Disney, but I'd like to buy it a little lower than that. I think that I'm looking at the 95, 97 area, maybe a bit lower than that even. So I'm going to hold off on picking that one up just yet. So let's see now. I got another question here. Let's see. So PK, I hope that answers your questions. My views on these stocks, I think they're both excellent stocks, but I'd like to buy them just a little lower. And maybe I'm being a little too cheap, but I think in this market, we will get some pretty good opportunities. And that's why I think cash is king. You want to keep your cash on the sidelines for that bad day when the market sells off. There's going to be some bargains. So Danielle's asking me, what do you think about U.S. banks like Bank of America and Morgan Stanley? Well, good question. We like Bank of America. Okay, the earnings on Bank of America don't look very good prior to 2012. But they've been getting better, and I think all the U.S. banks are back on track. And well, we think BAC can still grow. Right now, it's trading around 17 times earnings. It might be a little on the expensive side, but the earnings are growing nicely. So we think we like Bank of America, but I'd rather be buying it on weakness. And so again. I'm going to say that I'd rather see it in the 26 or south of 26 range. But again, I may not be able to get it there. So I'm being a little bit of a cheapskate, but I'm waiting for the opportunities to come to me. Now, I do like owning financials in markets like this because they pay nice dividends. In the case of Bank of America, it pays 48 cents a share, or 1.5%, which is okay. It's not a huge dividend for a bank stock, but it's not bad. And in terms of JPM, this is a picture for JPM, and JPM looks pretty expensive to me. We're trading around 16 times earnings. I think this usually on the low end will get closer to 12 times earnings. Now with all the tax reforms, these things have been picking up a lot. And they're saying that this is going to help, the tax reforms in the US are going to help the whole financial sector. So we could probably see further strength, and maybe, maybe I won't see the bargains that I'm hoping for. But I also believe that the markets are going to have some sort of a corrective phase, which should present some bargains. And in the case of JPM, you can see the other day when we had a market sell-off, JPM actually got down to about 105, 104, 105. Now we've been coming up, so hard to say where we'll go from here. Now, does anyone else have any other questions here? Oh, Phil, okay. What are your thoughts on Sally Beauty? Good results based on US tax reform, but price not reflective. That's a good question. Sally Beauty, unfortunately, has been a dog. I'm going to pull up the chart here. And you can see that the earnings have been growing. They actually have record earnings, okay? And part of that is from the tax reform. The thing that worries me about this company is that I think the barriers to entry are very, very low. I actually had the opportunity. I was in Texas just a few weeks ago. And so I did take the chance to go into a Sally Beauty store and speak to the people that were running the store and looked around at the business and all that. And quite frankly, I wasn't that impressed because I thought, gee whiz, anybody could get into this business. Now, it doesn't mean the stock will go down, but I think the stock is cheap. It trades at 8 times earnings. But the way I'm viewing this thing now is that if we get into the low 20s, I'm definitely going to be running and trying to put my money somewhere else. So that's the way I'm viewing this, is that I think this is an industry that can be upset by something like an Amazon or even a bigger player. So I'm not quite as bullish on Sally as I used to be, although the model tells me the stock is cheap. And I'll tell you something, the model, okay, the purple chips approach usually is right. Even if I think that the stock isn't going to do well, historically, if our approach is telling us that the stock is cheap, there's a very good chance that it is. And so we're probably going to see somewhere in the low 20s or even, maybe even the mid 20s again. So don't rush out there to sell it. But, you know, I kind of like some of the other stocks better than this. I'd rather be in a Walgreens or a CVS than a Sally. Anyone else have any questions at this point? Michelle is asking about Canadian stocks. Are there any Canadian stocks on the radar? Yes, there are. We've had Power Financial on our radar for a little while. We've had Loblaws on the radar. Let's just see here. Some of the other ones, Fiera, Power, Loblaws, and there's a few that are close. Transcontinental was close. At $23 would be a buyer of Transcontinental. Stantec at $33.50. TransCanada Pipe at $51. And Metro at $37. Look at that. Metro's actually pretty close. So those are the Canadian stocks that are on my radar right now. Now, what else? Phil is asking, if Sally hits low 20s, he's going to take his profits and run. Phil, I'm with you. I agree 100%. Michelle is asking me, do you have any idea about which way the Canadian dollar versus the US dollar exchange rate will go? That's the $64,000 question. I wish I had the answer. My own view is that I think, let's take a look here at the exchange rate, okay, just for fun. Let me just pull this up here, just a minute. We're going to get the Canadian dollar. There is a chart of the Canadian dollar. And you can see, this is, by the way, in US terms. So it costs, right now, it costs us about $1.25 and change. Actually, $1.26 to buy $1 US. My view is that we're probably going to gyrate between 120 and 135. And so I don't have any strong conviction. It really depends on who raises rates faster. So if the U.S. has an economy that's doing really well, then chances are the U.S. dollar will strengthen if the Canadian economy slows a little, let's say. So it really depends who's raising rates the fastest. And that's going to dictate which currency will do better. And Phil says, thanks. Any other questions? Does anyone else have any more questions for me? Okay, Peter. Peter says, concerning Facebook, considering that we've done well with it, what do you think about selling off now and waiting for it to drop before picking it up again? That's a tough call, okay? Because Facebook, let's just pull up the chart on this one here and have a look at it. The challenge I have with Facebook is that they're actually growing at 30–40% a year because the advertising money is moving into Facebook. And the stock is actually cheap right now. So it may correct further. It's very possible that if we have a market correction like what I'm thinking, maybe Facebook is going to go to 150. But maybe I'm wrong about this too. Okay, the thing is, the stock is a good deal. It's not that expensive relative to its growth, okay? Because it's always, what's the PE multiple compared to the growth rate? And they are growing at more than 30% a year. So this is actually not an expensive stock. So I'm willing to ride it out on Facebook because you can't just throw everything out, okay? In scenarios like this, you've got to sort of hedge yourself a little bit because, you know, even though I think the markets could have a continued correction, I'm not going to sell every one of my stocks. Some of these stocks are great deals. And what if I'm wrong too? So the worst thing you can do is get out 100% out of all your holdings, go cash, and then if you're wrong, you've got to wait until you're right. And I've seen people do that, and they've been out of the market for the last 2 years, and they've missed out on some great profit opportunities. And it's very hard to go back in once you get out. So I like to sort of thin out my holdings when I feel this way and have more cash and still stick with great companies. And that's the bottom line is you'll never get hurt like that. The market has always produced great profits in the long run. We may go through these bouts of corrections, but they're temporary because the economies do keep growing in the long run. So, does anyone else have any more questions for me at this point? And that was from Peter about Facebook. Thank you, Peter. That was a good question. Well, I think that pretty much wraps it up unless I see another one. Oh, here you go. Danielle says, should I sell Dollarama and Dollar General, or is it better to keep them in these times? I think Dollarama is a great stock, but I also think that it's a little on the expensive side. Now, let me just put up the Dollarama chart here, and let's just see here. So here we've got Dollarama, and I like Dollarama. They've got a fantastic track record. They trade at 35 times earnings, though. This is the only thing that concerns me, and I think that relative to their U.S. counterparts, I think that Dollarama is a little on the expensive side, but it is a great quality company. So maybe I'm the one who's wrong on this. I mean, I think the stock should trade closer to a 20 multiple or a 25 multiple, but investors love it. Now, one of the things that happens in Canada is that the Canadian funds and people looking for great stocks tend to pile in to the same stock, and so you get massive amounts of capital that direct themselves to a small group of stocks, and Dollarama is one of those stocks. So maybe it's going to remain expensive. So maybe I'm hedging myself a little bit there because I do like the stock, but I also want to buy it at a cheaper level. So in this scenario, I'm not owning Dollarama right now. I would be taking profits on it. So Danielle, I hope that answers your question. In terms of Dollar General, let's just see what we got here. Dollar General looks like it's on the expensive side of things too. I mean, right now it's trading at 21 times earnings, and I know we've owned that stock before, and we actually owned it around the 75 mark. And you know what? I wouldn't be surprised if it could get back in the 75 area again. So that's the way I see that evolving. Does anyone else? I'm going to take another question here. If anyone else has one more question, we'll go with that, and then I think we'll wrap it up. So you're welcome, Danielle. Danielle just told me thank you. Anyone else have another question for me? So I think that pretty much wraps it up. I just want to thank everyone for participating in this. It's fun for me. I love talking about this stuff, and I hope I've answered a few questions about the volatility. And remember to stick to the plan. Don't throw the baby out with the bathwater. You know, stay focused. And by the way, we are having another webinar on March the 13th. Okay, we will be having a webinar on how to start investing with Purple Chips. We're going to talk about things like position size and stuff like that. So it'll be more of a general webinar about how to best use the website. So please sign up for that as soon as you can. And I look forward to hearing from you again. And as always, thank you for following us on Purple Chips. So I'm going to sign off with that. I'm John Schwinghammer, the author of Purple Chips, and thanks for watching.